Interest refers to the cost of borrowing money or the return on savings. It's typically expressed as a percentage of the principal amount over a specific period. Types of interest. There are two main types of interest, simple and compound. Simple interest is calculated only on the principal, while compound interest is calculated on the principal plus any accumulated interest. The role of interest in finance. Interest plays a critical role in the economy by influencing consumer behavior, investment decisions, and economic growth. It affects how individuals save, spend, and invest their money. Why understanding interest matters. A solid grasp of interest helps individuals make informed financial decisions, optimize savings, and minimize borrowing costs. It is essential for smart investing and financial planning. Formula for simple interest. So the formula for calculating simple interest is simple interest equals principal times rate times time. Here, P represents the initial amount invested, R is the interest rate per period, and T is the time in years. This formula illustrates how interest accumulates linearly over time. For example, if principal amount of $1,000 is invested at an annual rate of 5% for 3 years, $1,000 times 5% times 3 equals $150. Thus, the total amount after interest would be $1,150. This simple calculation can be applied to various situations to understand interest earnings. Applications of its simple interest. Simple interest, widely used in short-term loans, personal loans, some savings accounts. It provides predictable returns and is easier to calculate compared to compound interest, making it a popular choice for consumers and businesses alike. Formula for compound interest. The formula for compound interest is A equals P times bracket 1 plus R divided by N bracket to the exponent N times T. Here, A is the amount of money accumulated after N years, including interest. P is the principal amount, R is the annual interest rate, and N is the number of times interest compounded per year, and T is the number of years the money is invested. Calculation examples. For example, an initial investment of $1,000 at an interest rate of 5% compounded annually for 10 years will result in A equals 1,000 times bracket 1 plus 0.05 divided by 1 bracket to the exponent of 1 times 10 equals $1,628.89. This illustrates the power of compound growth over time, leading to significantly higher returns compared to simple interest. The key difference between simple and compound interest lies in how interest is calculated. Simple interest is calculated only on the original principal, while compound interest is calculated on the principal and accumulated interest over time, leading to exponential growth. Definition of principles. Value investing is an investment strategy that involves selecting stocks that trade for less than their intrinsic values. This involves careful analysis for companies to identify hidden potential for returns over time. Importance of financial planning. Value investing is crucial in financial planning as it encourages disciplined investment strategies that prioritize long-term gains over short-term speculation. Historically, it has provided significant returns and helps build wealth sustainably. Key strategies for value investing include screening for undervalued stocks using fundamental analysis, seeking companies with strong financial health, and evaluating long-term growth potential. Patience and discipline are essential for success. Growth investing targets companies expected to grow at an above average rate compared to their industry or their overall market. Key principles include focusing on potential future earnings rather than current valuations, accessing market trends, and evaluating a company's business model and competitive advantage. While value investing seeks undervalued stocks trading below intrinsic value, growth investing prioritizes stocks anticipated to grow quickly. Growth investors accept higher valuations, focusing on future earnings potential instead of current price metrics, which contrasts sharply with value approach. Successful growth investing strategies include investing in technology sectors, identifying market disruptors, and focusing on innovative companies. Investors often utilize metrics such as the price earnings growth PEG ratio to evaluate growth potential relative to price.